Every day, thousands of people open a brokerage account, fund it with money they worked hard to earn, and start day trading. And within 1 year, statistically, 97% of them will have lost money. Not because the market crashed, not because they got unlucky, because the game they decided to play is one of the most statistically brutal wealth destroyers ever created for regular people. Here's what makes this worth talking about. Day trading looks like investing. It uses the same apps, the same charts, the same vocabulary, but it is not investing. It is something else entirely. And understanding the difference could save you years of losses and the kind of financial damage that takes a decade to recover from. In the next 8 minutes, I'm going to show you exactly why the math of day trading is designed to beat you, what the data actually says about who wins and who loses, and what the small group of people who actually build wealth do instead. Let's get into it. Let's start with the numbers because the numbers are the whole story. A landmark study out of Brazil tracked over 19,000 people who tried day trading over a multi-year period. These weren't random people. These were people committed enough to stick with it for more than 300 days. People who studied, practiced, and kept going despite early losses. The result? 97% of them lost money. Only 1.1% made more than minimum wage, and only 0.5%, less than 1 in 200, made what you'd consider a meaningful income from it. Similar studies from Taiwan, the United States, and Europe tell essentially the same story with essentially the same numbers. Now, here's the part the trading course industry doesn't want you to think about too carefully. If 97% of people who commit seriously to day trading still lose money, the problem is not the traders. The problem is the game itself. The game is structurally designed for most participants to lose. And once you understand why, the appeal of day trading starts to look very different. There are 3 structural reasons why day trading produces losers at a 97% rate, and none of them have anything to do with how smart you are. Reason 1. Transaction costs compound against you. Every trade costs money. Commissions, spreads, the tiny gap between the buying price and the selling price of every asset you touch. These costs feel small per trade. But a serious day trader might make dozens or hundreds of trades per day. Those small costs compound relentlessly, and they compound against you every single time, win or lose. A long-term index fund investor might pay 0.03% a year in fees. A day trader might pay that much in a single morning. The math works against you before the market even opens. Reason 2. You are competing against machines. The people on the other side of your trades are not other individual investors sitting at laptops trying to figure it out. They are institutional algorithms built by teams of PhDs running on servers physically located inside stock exchanges to shave microseconds off every transaction, executing strategies more sophisticated than anything any individual can replicate. When you buy, something sold to you. When you sell, something bought from you. That something is almost always faster, better informed, and better capitalized than you are. You are not competing against the market. You are competing against the smartest, fastest, most resourced financial entities in human history. Every single time. Reason 3. Losses hurt more than gains help. This is behavioral economics, and it destroys traders psychologically before it destroys them financially. Humans feel losses roughly twice as intensely as equivalent gains. Lose $500 and it hurts far more than winning $500 feels good. For a day trader, this is catastrophic. It leads to holding losing positions too long, hoping they recover, cutting winning positions too early to lock in the feeling of a win, and making increasingly erratic decisions after a string of losses in an attempt to get back to even. The psychological spiral of day trading is not a side effect. It is almost guaranteed by how human brains are wired. So why does anyone keep doing it? Because of a mechanism that behavioral scientists call survivorship bias. And the day trading industry has built an entire business model around it. Here is how it works. The 3% of day traders who make money are extremely visible. They post their winning trades. They sell courses. They have large audiences. They are the faces of day trading content everywhere you look online. The 97% who lose money are invisible. They quietly close their accounts, absorb their losses, and move on. They don't make content about it. They don't build audiences around it. They disappear. So if you spend any time in day trading communities, on YouTube, on Reddit, on social media, your entire information environment is populated almost exclusively by the 3% who won. The 97% who lost are simply not there. The sample you're seeing is not representative. It is the most extreme selection bias imaginable. This is why day trading looks profitable from the outside. The winners are loud, the losers are silent, and the industry profits enormously from new participants who enter believing the visible minority represents the realistic outcome. Here is what the people who actually build wealth consistently do, and it is almost offensively simple compared to the complexity of day trading. They buy broad, low-cost index funds every month, automatically, and they do not sell. That's it. That is the entire strategy that has outperformed the vast majority of professional fund managers, not just individual day traders, over virtually every meaningful long-term time horizon. The S&P 500 has returned an average of roughly 10% annually before inflation over the past century. Through recessions, crashes, wars, pandemics, and every kind of economic chaos imaginable. The long-term investor who stayed in through all of it consistently came out ahead of almost everyone who tried to be clever about it. Warren Buffett, arguably the greatest investor who ever lived, has publicly and repeatedly said that most investors, including professionals, would be better served by simply buying an S&P 500 index fund and leaving it alone. He said this in front of rooms full of professional money managers. The data backed him up every time. The wealth builders also do something day traders almost never do. They let time do the heavy lifting. A day trader is trying to extract profit from markets in hours. A long-term investor is letting compound interest work across decades. These are not just different strategies. They are operating in completely different dimensions of time and risk. I want to be clear about one thing before you go. This video is not about telling you what you can and cannot do with your money. If you want to trade, that is your choice to make. This is about making sure that choice is informed by the actual data, not by the loudest voices in the room, not by highlight reels of winning trades, not by a course that profits from your belief that you can be the exception. The statistics are not a matter of opinion. 97% of committed day traders lose money. The structural reasons are not going away. The machines are not getting slower. The transaction costs are not disappearing. The boring alternative, consistent, automated, long-term index fund investing, has the most compelling track record of any wealth-building strategy available to ordinary people. Not because it's exciting, because it works. Choose the thing that works. If this video gave you something to think about, hit the like button and share it with someone who needs to hear it. I'll see you in the next one.